Imagine starting with like $225 million in seed money.
Which is already, a massive amount of capital.
Right. But then in just 2 years, you multiply that into a staggering $45 billion.
Delivering, what, a 439% net return?
Exactly. In a single 6-month period. I mean, you are being hailed as the visionary architect of the artificial intelligence boom.
It's the kind of run most fund managers literally dream about.
Yeah, but then over the course of just one single week, you lose the entire public portfolio. Like the billions just vanish, the prime brokers seize the assets, and the game is over.
It really is the kind of wealth destruction that is almost difficult to comprehend. We are not just talking about a bad quarter here.
No, not at all.
We are looking at a structural vaporization of capital, and at a scale that, honestly, threatened the underlying stability of the broader financial system.
Welcome to the deep dive. Today, we are opening up an incredibly detailed, institutional-grade autopsy report of the July 2026 implosion of Situational Awareness LP.
It's wild to even look back at it now.
It really is. This was a massive hedge fund run by a mid-20s of former artificial intelligence researcher.
Yeah.
And its collapse is one of the most spectacular financial unwinds in modern history.
Truly unprecedented.
So the mission for our deep dive today is to help you understand the precise mechanics of this catastrophe. We want to extract vital lessons about risk, the dangerous illusion of diversification, and the physical reality of the AI boom that we are all living through right now.
A textbook case of what not to do.
Yeah, definitely. But before we get into the architect of this massive trade, a quick note on how you can run your own market analysis using the tools available today.
Always important.
To access more advanced researches, applications, and our latest Deep Values agents, welcome to Explore and Join Deep Values APP. Track total market temperature, welcome to search and download iOS app Buffett Indicator from Apple App Store or Bubble Watch from Google Play. Disclaimer. All analysis is based on publicly available sources and may be subject to revisions or differing interpretations. All contents from this channel is for research and entertainment purposes only and does not constitute any investment or financial advice or service. Conduct your own due diligence before making investment financial decisions.
Okay, so with that covered, to really grasp how a multi-billion-dollar catastrophe of this magnitude actually happens, we can't just look at the crash itself, right?
Right.
We have to start at the foundation, we have to look at the architect, and this uncompromising idea that set this entire machine into motion.
So let's look at the guy behind the curtain, Leopold Aschenbrenner.
Right.
This is not your typical Wall Street veteran, at all. He was a 25-year-old former researcher with literally zero prior professional trading or portfolio management experience.
25.
Yeah.
That detail always gets me.
I know. So he grew up in Germany, child of medical professionals, and showed this intense early aptitude. He actually graduated as valedictorian from Columbia University with a degree in economics and math statistics.
And he was, what, only 19 at the time?
Yeah, 19 years old. Just brilliant on paper.
His background is actually deeply rooted in the effective altruism community, which, focuses heavily on long-termism and existential risks.
Right.
And that philosophical leaning led him to a brief stint at the FTX Future Fund under Sam Bankman-Fried. This was right before that whole cryptocurrency exchange collapsed in 2022.
Which, that connection becomes a glaring red flag in retrospect.
Oh, absolutely. Given the shared reliance on extreme leverage and this sort of cult of personality that tends to form around young, supposedly infallible geniuses.
Totally. But the real turning point happens at OpenAI. Aschenbrenner joins their super alignment team in 2023.
Right, working on the really heavy stuff.
Yeah, he is working directly under heavyweights like Ilya Sutskever. They're trying to figure out how to control AI systems that will eventually become smarter than humans, but it doesn't last.
No, it ends pretty abruptly.
Yeah, in April 2024, he is fired over an alleged information security leak. He publicly disputes this, saying he was pushed out for raising safety concerns and that he was just sharing a non-confidential planning document for peer feedback.
The classic Silicon Valley drama.
Exactly. But regardless of the drama, he takes his insider knowledge, and in June 2024, he drops this viral 165-page manifesto called Situational Awareness, The Decade Ahead.
And that essay, that is the key to understanding everything that follows. It wasn't just a think piece.
No.
It became the definitive intellectual blueprint for the entire AI infrastructure trade over the next 2 years. His core argument was that artificial general intelligence, or AGI, is not some distant sci-fi dream.
Right, he's saying it's right around the corner.
Exactly. He argued it is a highly plausible reality by 2027. But more importantly, he argued that the race to AGI isn't being bottlenecked by algorithms or software engineering anymore.
Oh, okay, let's unpack this. He is saying the bottleneck is literal gigawatts of electricity.
Yes, physical limits.
It's the concrete required to build data centers. It's the advanced semiconductor fabrication facilities, the cooling systems, the land rights. He's looking past the software completely.
That is the core of it.
Mhm.
He envisioned the construction of trillion-dollar compute clusters that would require the total mobilization of American industrial might.
Trillion-dollar clusters, wow.
Now, these are facilities being built by what the industry calls hyperscalers, the massive tech titans like
Mhm.
Amazon, Google, and Microsoft.
Okay.
These hyperscalers are the ones pouring hundreds of billions of dollars into capital expenditure. And while everyday retail investors were, crowding into software providers and primary chip designers, he argued something else entirely.
What was his play?
He said the generational wealth would be captured by whoever controlled the physical, hard asset bottlenecks that those hyperscalers desperately needed to keep building.
I mean, I love this concept. It's like ignoring the people panning for gold in 1849, right? And instead, you're buying up all the shovel factories, the local lumber yards, and the regional water rights.
Exactly. You own the infrastructure.
You know they need those things to mine, so you corner the supply chain. But here's my pushback for you.
Lay it on me.
Is it really that simple to just buy infrastructure? Or does expressing that view in the complex global equities market require a level of operational and financial expertise that a 25-year-old researcher simply might not have?
And that tension, that exact question, is where the foundation of this crisis was poured. Because recognizing a macroeconomic truth is one thing.
Right.
Effectively weaponizing that truth into a highly leveraged financial instrument is an entirely different skill set.
Yeah.
The underlying theory was fundamentally sound, and the logic was elegant. It absolutely captivated the Silicon Valley elite. But turning a brilliant white paper into a resilient hedge fund requires an understanding of market mechanics that you cannot learn just by being the smartest person in the room.
Well, here's where it gets really interesting, because he actually pulls it off, at least initially, right?
Yeah, he really does.
He transitions from researcher to portfolio manager and launches Situational Awareness LP in mid-2024. And he bypasses traditional institutional capital entirely.
Which is pretty rare for a launch that size.
Very rare. He raises his $225 million seed round directly from tech royalty. We're talking the founders of Stripe, the former GitHub CEO, and incredibly, the highly secretive quantitative trading firm Jane Street Group.
And Jane Street rarely ever backs external first-time discretionary managers.
Exactly. So with that capital, Aschenbrenner builds what is essentially a massive macroeconomic barbell. The portfolio was radically concentrated.
Highly concentrated. By early 2026, his U.S. public equity long book had just 26 positions.
Just 26.
Yeah. And he completely bypassed the big, famous AI megacaps. Instead, he went aggressive into the second and third derivative picks and shovels we just talked about.
Right. So we're talking 22.8% of the public book just in Bloom Energy. He was looking for on-site power generation to basically bypass municipal grid delays.
Smart move, honestly.
Yeah, and huge positions in SanDisk and SK Hynix for memory bandwidth, plus specialized GPU cloud providers like CoreWeave and Nebius Group. But the wildest move by far was his massive pivot into legacy Bitcoin miners.
Oh, yeah. It was a brilliant, albeit dangerous, tactical pivot. He poured over $1.38 billion into cryptocurrency miners like Core Scientific and CleanSpark.
Which sounds crazy at first.
Right. If you look at a Bitcoin miner on the surface, it seems totally unrelated to an AI language model. But Aschenbrenner realized these legacy miners possessed exactly what the AI hyperscalers desperately needed.
Secured gigawatt power contracts.
Exactly. Vast tracts of land and high-density cooling infrastructure. He realized you could physically retrofit these crypto facilities into high-performance AI data centers.
Unbelievable.
He ended up owning an estimated 8.2% of the entire outstanding float of Core Scientific.
But wait, to finance all this infrastructure buying, he built a massive short book too, right?
He did.
He heavily shorted legacy enterprise software companies like Adobe. He also bought $8.46 billion in listed put options against the VanEck Semiconductor ETF, or SMH, and NVIDIA.
Massive hedges.
Let me stop there because this seems totally contradictory to me. If you are predicting a massive economic boom driven by AI, why aggressively short legacy software companies? Doesn't that expose you to massive unnecessary risk when a rising tide is supposed to lift all boats?
You'd think so. But the logic was rooted in his extreme conviction about what AGI would actually do to the economy.
Okay, how so?
He believed autonomous AI agents would natively generate code and execute complex workflows on their own. In his view, That completely destroys the pricing power and economic moats of traditional software as a service providers.
Oh, I see. So software becomes cheap or free.
Right. And the massive put options on the broader semiconductor indices were meant to be his macroeconomic hedge. If the AI trade suffered a severe cyclical drawdown, those semiconductor puts would theoretically explode in value.
Offsetting the deep losses in his physical infrastructure stocks.
That was the plan, anyway.
But to generate that astonishing 439% return in the first half of 2026, you need more than just a smart barbell of stock picks. Like, the math on just picking good stocks doesn't get you to 439% in 6 months.
No, it definitely doesn't.
I need gasoline.
And the gasoline was extreme, concealed leverage. The fund had a staff of just 8 people, only 4 of whom were investment professionals.
8 people managing all that.
Yeah. Yet they were managing a portfolio that peaked between $20 billion and $45 billion, operating with gross leverage running as high as 4 times their underlying equity.
How does an 8-person team even do that? If you're running tens of billions of dollars at 4x leverage, shouldn't the regulators be all over you?
What's fascinating here is the precise financial instrument they use to stay invisible. It's called a total return swap, or TRS.
Okay, break that down for me.
They set these up with top-tier prime brokers like Goldman Sachs and JP Morgan. In a total return swap, the hedge fund doesn't actually buy the stock.
Wait, they don't buy it?
No.
Yeah.
The prime broker buys the physical shares, holds them on its own balance sheet, and simply passes the economic returns, so the gains or losses, back to the hedge fund.
And what does the fund give the broker?
In exchange, the fund posts a tiny fraction of the asset's value as initial margin, often as low as 5 to 15%, and pays a floating financing rate.
That is wild. It's like renting a multi-million-dollar mansion for a few $1,000s a month. You get to act like you own the place, you put your name on the mailbox, but if the property value drops by even a fraction, the landlord can legally demand you hand over the full value of the house in cash by midnight.
That analogy hits the nail on the head. Because they didn't legally own the shares, the full extent of the fund's massive leverage and concentration was totally invisible.
Hidden from the SEC.
Not just the SEC. It was hidden from their own counterparties. Each prime broker only saw the specific slice of risk they were financing. No single bank knew the aggregate fragility of the whole structure.
Wow.
And at 4x leverage, the math is unforgiving. A 10% upward move in the market translates to a 40% gain for the fund. But a 25% decline in the portfolio entirely wipes out your underlying equity cushion, plunging you into negative territory instantly.
That sounds exactly like what happened a few years ago.
It is. This off-balance sheet leverage mirrors the exact systemic vulnerabilities we saw in the 2021 Archegos implosion.
Right. So they've built this massive, invisible house of cards using total return swaps. But, a house of cards only stays up if the air in the room is perfectly still.
And the air did not stay still?
No. In July 2026, the macroeconomic wind started blowing, setting the stage for the spark that blew the whole thing up.
The macro picture turned ugly incredibly fast. First, SK Hynix, a massive South Korean memory chip maker, which the fund held, posted disappointing earnings.
And that triggered a global semiconductor sell-off.
Yes. Then the Federal Reserve took an aggressively hawkish tone, sending 30-year Treasury yields spiking. And the fatal blow came when Alphabet reported a $205 billion capex plan dedicated to AI.
$205 billion.
Yeah, which resulted in their first ever negative quarterly free cash flow. Investors were terrified. They started asking the dangerous question, when will these massive hyperscaler infrastructure investments actually pay off?
And that fear triggers a violent downward spiral. The specific physical infrastructure stocks in Aschenbrenner's long book completely crashed. I mean, SanDisk fell an astonishing 56%.
Nebius Group plummeted 48%.
And the Bitcoin miners suffered brutal synchronized drawdowns, well over 30%.
Yeah.
But wait, what about the $8.46 billion in put options on the broader indices like SMH?
The hedges.
Yeah. This was supposed to be their insurance policy. I'm looking at this math. Well, I mean, if they held puts on the broad index, but their actual stocks were highly illiquid niche companies, wouldn't their specific stocks crash way harder than the index they bet against?
You just identified the exact flaw that killed them. In quantitative finance, that is called basis risk.
Basis risk.
Yeah. The broader mega-cap semiconductor indices, the companies with massive balance sheets, didn't fall nearly as hard or as fast as the highly illiquid niche infrastructure stocks Aschenbrenner was holding.
So they didn't balance out at all.
Not even close.
Yeah.
So the physical bottleneck stocks fell 2 to 4 times harder than the hedges could compensate for. The physical reality of the assets decoupled from the broader market sentiment.
Wow.
That multi-billion-dollar insurance policy was mathematically useless when they needed it most.
So the insurance policy burned down at the exact same time the house did. And to make it worse, institutional capital fleeing the AI crash rotated heavily into the exact legacy software companies, like Adobe, that the fund was aggressively shorting.
Yep, the short squeezed.
So the things they own are tanking, and the things they bet against are surging. It's a textbook double whammy.
Which raises an important question. What happens behind the scenes at the big banks when a massive client suddenly starts hemorrhaging cash on both sides of their portfolio?
Chaos, I assume.
The reality of quantitative finance is dictated by value at risk, or VAR, shocks.
Hold on, VAR shocks. What exactly is value at risk, and why does a shock to it trigger a meltdown?
Value at risk is essentially a statistical threshold that banks use to gauge the maximum potential loss a portfolio could suffer over a given time frame.
Okay, makes sense.
When market volatility explodes beyond what the bank's historical models predicted, that is a VAR shock. It sets off automated alarms deep inside the prime broker's risk departments.
And because both sides of his portfolio were bleeding.
Because the long book crashed and the short book squeezed simultaneously, the fund's equity cushion was consumed almost instantly. The prime broker's risk models demanded immediate, massive injections of cash to maintain the swaps.
So the banks call up and say, we need billions in cash by the end of the day to cover the drop in value. But the fund doesn't have the cash.
Exactly. And that triggers a mechanical deleveraging leap. Because they don't have cash, the fund is forced to sell assets to raise it.
Which just pushes the price down even further.
Precisely. Dumping millions of shares depresses the stock prices even further. That further drop erodes whatever collateral they have left, which spawns even larger margin calls from the prime brokers.
It's a mathematical death spiral.
It really is. Just days before this, Aschenbrenner had sent a letter touting his 439% returns and asking for fresh capital. By the final week of July, he was frantically begging existing investors for emergency liquidity over a weekend.
Which was probably an impossible task.
Entirely impossible.
So by Wednesday, July 29, the music completely stops. The prime brokers formally seize control of the entire public equity book. But why do the prime brokers have the legal authority to just take the portfolio? And why did they panic and seize it rather than, giving the fund a week to sort things out?
This goes back to those total return swaps. Because of how those swaps are legally structured, the prime brokers aren't just lenders. They are the actual legal owners of the stock.
Oh, right. The landlord.
Right. The second that equity cushion hits zero, a contractual clause is triggered, giving the banks the right to instantly seize and liquidate the portfolio to protect their own balance sheets.
And they panicked because of the concentration.
Yes. They were staring at a massive pile of highly concentrated, illiquid stock, like that 8.2% stake in Core Scientific. If the banks just dumped that onto the open market in an uncoordinated fire sale to get their money back, it would have overwhelmed dealer liquidity.
Meaning there wouldn't be enough buyers to absorb the shares, so the price would plummet to zero, taking the bank's money with it.
Furthermore, it would have forced mechanical de-risking from every other thematic tech fund in the market, causing a massive chain reaction.
So they were afraid of contagion.
Very afraid. The banks remembered the billions in losses they ate during the Archegos fallout. They desperately needed a single buyer with incredibly deep pockets to absorb the entire directional risk in one private transaction away from the public exchanges.
Enter Ken Griffin and Citadel.
Yep.
Citadel wins the bid and buys the entirety of the Situational Awareness public stock portfolio in a single, massive block trade at a steep discount.
They step in and clean it up.
Right. They take the risk entirely off the public tape, preserving the integrity of the bid-ask spreads and establishing a firm market floor. The panic immediately subsides. But here is the bitter, devastating irony of this whole story.
This is the crazy part.
The very next day, Thursday, July 30, the market rebounds massively.
The relief rally was monumental. Bloom Energy surged 26.5%. Nebius Group jumped 27.1%. The iShares semiconductor ETF retraced almost all of its losses.
It's like successfully crossing a treacherous, violent ocean in a tiny boat, only to drown in a puddle on the beach because you forgot to take off a 100-pound weighted vest.
That is a brutally accurate way to phrase it.
I mean, Aschenbrenner was fundamentally correct about the underlying intrinsic value of these physical assets. The market validated his thesis literally the next day, but because of his extreme leverage, he was forcibly removed from the game hours before the recovery began.
If we connect this to the bigger picture, it highlights the most brutal truth of leveraged finance. When you are operating with 4x gross leverage, the math of losing works against you significantly faster than the math of winning.
Because the drops hurt more than the gains help.
Right. A 25% drop doesn't just hurt your yearly return, it mathematically vaporizes your entire principal. In quantitative finance, we call this variance drag and nonlinear drawdowns.
But in plain English.
In plain English, it means that maximizing returns with extreme leverage mathematically guarantees your ruin eventually. Portfolio management ceases to be about your fundamental thesis and becomes a desperate game of merely surviving volatility.
The market is entirely indifferent to your genius if you are fatally overleveraged. But the story doesn't end with total annihilation. The fund didn't completely die, which is wild to me. The prime broker margin calls only applied to the liquid public stock portfolio.
Correct.
Their illiquid private venture capital book survived completely untouched because those assets weren't financed through daily mark-to-market swaps. And the crown jewel of that private book is a $5 billion equity stake in Anthropic, the developers of the Claude AI model.
Which they got into early.
Yeah, and it has seen a 1,000% unrealized paper return.
And the survival of that specific asset carries a profound sociological irony.
Oh, because of his background.
Yes. Remember, Aschenbrenner was fired from OpenAI. He's now engaged to the chief of staff at Anthropic CEO, Dario Amodei.
Wow.
So this massive hedge fund, originally built by an exiled OpenAI researcher to trade the global macro trajectory of AGI, now exists almost entirely as a captive holding company for OpenAI's biggest competitor.
It's walled off from the prime brokerage disaster, just safe in the private markets. So what does this all mean? If you are listening to this, maybe looking at your own tech portfolio right now, thinking you're being smart about spreading your bets, what is the real takeaway here?
Well, the foremost lesson for any investor is recognizing the dangerous illusion of diversification. If you look at what Aschenbrenner built, he had a portfolio of power generation companies, memory chip fabricators, specialized cloud providers, and repurposed Bitcoin miners.
Yeah, on paper, across traditional sector classifications, that looks incredibly diverse. You own utilities, tech hardware, crypto mining, and data centers.
Right. If you look at your own brokerage account, you might feel safe because you own 5 different types of businesses. But it wasn't actually diverse at all, was it?
Not at all.
It wasn't diverse because under severe macroeconomic stress, every single one of those seemingly disparate assets violently collapsed into a single, highly correlated risk factor.
Hyperscaler capital expenditure.
Exactly. When the market suddenly doubted the timeline and the return on investment for massive AI spending sparked by Alphabet's negative free cash flow, the entire physical supply chain repriced downward at the exact same moment.
Because they were all relying on the exact same customer base and the exact same macroeconomic narrative.
True diversification requires fundamentally uncorrelated revenue drivers, not just different ticker symbols.
It also means that using broad index-level derivatives to hedge idiosyncratic, highly specific equities is a structural failure. You cannot buy puts on a mega-cap semiconductor ETF to protect a portfolio of small-cap crypto miners and niche power companies.
No, you can't.
When liquidity dries up, those niche stocks are going to get crushed so much harder than the broader index. The math of basis risk will simply not save you.
And this also shines a massive spotlight on a systemic vulnerability in our financial system. The extensive proliferation of total return swaps continues to allow these multi-billion-dollar risks to silently accumulate on the balance sheets of our biggest banks.
Because of the reporting loopholes, right?
Yeah. Right, because SEC 13F filings only require the disclosure of long U.S.-listed equities, the massive swap exposures, the aggressive short books, and the extreme leverage ratios remain entirely hidden from the broader market until it is just too late.
Which brings us to the final thought we want to leave you with today. If a 25-year-old with zero professional trading experience can quietly use total return swaps to amass a $45 billion leveraged powder keg entirely outside the purview of regulators,
It makes you wonder.
it raises a terrifying question for you as an investor. What other invisible, highly correlated risks are sitting on the balance sheets of Wall Street right now, just waiting for a single bad earnings report to light the fuse?
It's definitely something to think about.
We are glad you joined us for this deep dive. Stay curious, mind your leverage, and we will catch you on the next one.